Assalamualaikum warahmatullahi wabarakatuh and hello everyone. So we are from group 5. We will continue presentation from group 4 for the topic 5, which is corporate ethical governance and accountability. Before that, we want to thank our lecturer Puan Arfa Hanum for giving us the opportunity to make a presentation. Okay guys, my name is Naatira Mithjipi. My matric number is 011819F1089.
I'm Iza.
Hai dan salam sejahtera. My name is Ayati Anak Perempuan Nakit. I'm from group 5 and my matrix number is 01D8019F1094.
Hi, my name is Lashni Murali. My matric number is 01D8019F1101.
Assalamualaikum and hi, my name is Shaukin Anaswaha binti Zainuddin. My matric number is 01D8019F1121.
So guys, this is our content. So let's get started. So today I will present for the topic 5.4.3, which is provide explanation on the framework of corporate governance in Malaysia. So we have three. The first one is institutional, the second one is regulatory bodies, and the last one is statutory. So we go for the first one, which is institutional. So institutional investors are asset owners and asset managers with equity holdings in corporate listed on Bursa Malaysia. The activities of institutional investors include managing and allocating funds, designing investment policy and strategy, awarding investment mandates, and also the monitoring investment activities. Institutional investors are the major players in the global economy who can exert significant influence over their investing companies due to the substantial stake they hold. This also can provide them with an opportunity and the ability to encourage the good governance and appropriate behavior by their investing companies to ensure their delivery of sustainable long-term value for their beneficiary or clients. Okay, next, institutional investors should be led by capable board and management with the appropriate capacity and experience to effectively discharge their stewardship duties. And then institutional investors are also encouraged to engage in the development of relevant policies and the best practice. Besides that, the Malaysian Code for Institutional Investors is a voluntary code which set out the broad principle of effective stewardship by institutional investor, followed by the guidance to help institutional investor understand and implement the principle. And also, in addition, the economic consideration, the code advocates institutional investor to ensure that they invest in a responsible manner by having regard to corporate governance and sustainability of the company. So now we've moved for the second one, which is regulatory bodies. Regulatory bodies means those government department and regulatory, statutory or other entities, committees, embarrassment and bodies which whether under statute, rules, regulation, code of practice or otherwise are entitled to regulate, investigate or influence the matters deal with in the contract or any other affairs of the authority and regulatory body shall be construed accordingly. So the first one of the regulatory bodies, which is Bursa Malaysia. Bursa Malaysia adheres to high standard of corporate governance practice under the leadership of the board as guided by Malaysian Code of Corporate. The Bursa Malaysia ever-evolving business landscape presents a set of risks to the business and financial performance. The Risk and Compliance Division activity monitor these risks, which they have classified into 4 categories to facilitate oversight and control. And then the Corporate Governance Guide by Bursa Malaysia Berhad seek to enrich the application and actualization of corporate governance practice by providing practical guidance to listed issuers. Next, the second one is Secretary Commission Malaysia. The Secretary Commission Malaysia is dedicated toward promoting the internalization of a culture of good governance among capital market participants. Greater emphasis is being placed on self and market regulation to complement the existing comprehensive regulatory framework. And then they believe that a strong corporate governance culture must be premised on a dynamic synthesis of efforts between regulators and the market. Okay, the third one is Companies Commission Malaysia. The Companies Commission Malaysia, or we also known as SSM, is a statutory body formed as a result of a merge between the Register of Companies (ROC) and the Register of Businesses (ROB) in Malaysia, which regulates companies and businesses. SSM came into operation on 16 April 2002. The main activity of SSM is to serve as an agency to incorporate companies and register businesses, as well as to provide company and business information to the public, and also as the leading authority for the improvement of corporate governance. SSM fulfills its function to ensure compliance with business registration and corporate legislation through comprehensive enforcement and monitoring activities, so as to sustain positive developments in the corporate and business sector of the nation. So we move for the next is the Malaysian Accounting Standard Board, or MASB. Okay, MASB together with the FRS make up the framework for financial reporting in Malaysia. Okay, this framework comprises an independent standard setting structure with representation from all relevant parties in the standard setting process, including preparers, users, regulators, and the accountancy profession. Okay, the MASB is guided by a clear set of policy objectives. The first one is to develop high quality accounting standard for financial reporting that benefit users, preparers, auditor, and the public. The second one is to participate in the contribute to the International Accounting Standard Board, IASB, and the last one is to collaborate with other national standard setters for the development of globally accepted financial reporting standard for international use. And the last one for regulatory bodies is Malaysian Institute of Corporate Governance, MICG. Okay, incorporate as a company limited by guarantee, its founding members consisting of the Federation of Public Listed Company, FPLC, Malaysian Institute of Accountants, MIA, Malaysian Institute of Certificate Public Accountant, MICPA, and Malaysian Institute of Chartered Security and Administrators, MAICSA. Okay, MICG's principal activities are to promote and encourage corporate governance development, provide education and training for the benefit of its members and other interested institutions or bodies in Malaysia. So now we go to the last one framework of corporate governance in Malaysia, which is statutory. Okay, greater emphasis is being placed on self and market regulation to complement the existing comprehensive regulatory framework. That believe a stronger corporate governance culture must be premised on a dynamic synthesis of efforts between regulators and the market. The statute set out clear and transparent rules pertaining to the creation of the business, incorporated at a federal level, the rights and responsibility of management, the board and shareholders, and financial accountability. So that's all from me with my points. Now I will pass our presentation to my members.
So I'm going to continue with 5.4.4. Ascertain the features of poor governance. Poor governance is a relationship between those who govern and those who are governed as a consequence of decision making. This unfavorable relationship is created as a consequence of external factors or decisions such as violations of central or acceptable norms such as those of liberal democracy and bad economic policy. Bad governance collectively encompasses governance in government and corporate setting. It is the opposite of good governance. Bad governance addresses the governance in a government setting, but bad governance and bad government are different concepts. Bad governance encompasses a variety of situations from corruption, deceit, and to passing of unfair policy. From this, it can be noted that different manifestations of bad governance can vary in severity and the potential impact in their respective setting. The World Bank has identified key indicators of governance which are used as a method to measure poor governance. So I'm going to continue with causes of poor governance. First, lack of voice and weak accountability. Governing bodies refusing to listen to the voice of those they govern and refusing to take accountability for their actions leads to bad governance. By ignoring the voice of those being governed, their opinions are no longer heard or taken into consideration by the governing body. Democratic governments focus on accountability as a method to ensure the public understands what's happening and provide them a way to proceed when things go wrong. Weak accountability in turn causes a distrust between the two parties and can lead to instability. This distrust and uncertainty creates an unfavorable relationship between the parties. The second causes of poor governance is political instability. Bad governance occurs as a consequence of frequent changes in government or political instability. Instability in political regimes such as democracy has been proven to coincide with poor governance. Next, we are going to see about corruptions. Corruptions also causes of poor governance. Bad governance is often considered to come in hand in hand with corruptions. Corruptions occurs in many sectors ranging from political to economic environments. Corruption can occur in many different ways and forms. The existence of corruption within a governing body causes bad governance as the officials places their personal gains and other things. We are going to see about impact of poor governance. First, poor economic growth. Bad governance heavily impact the per capita growth of a country. African countries has experienced this impact the most since World War II. The economic growth of a country is significantly impacted when exposed to indicators of bad governance, but different indicators influence the degree of impact. a lack in regulatory quality, government's ineffectiveness, and a lack of control on corruptions have been linked to poor economic growth. Next, we are going to see about the impact of poor governance. First, corruption. Corruption not only is the cause of but can also occur as a consequence of bad governance. There was a distinct link suggested that higher level of governance and a better environment to conduct business are impacted by the presence of corruptions within an economy. This link suggests that as levels of governance in an economy due to bad governance, the level of perceived corruption will rise. I am continuing with solution to poor governance. Solution to poor governance, first thing is transparency. The World Bank Institute has suggested that through introducing reforms that address transparency, the degree of bad governance can be levitated and good governance can slowly take precedence. These reforms include disclosure to the public of all assets and income of candidates running for public office. Second, disclosure to the public of all political contribution to parties along with all documentation related to legislation and voting in parliament. The second solution to poor governance is dealing with corruptions. A strong correlation exists between bad governance and corruptions. By curbing corruption within governing bodies, bad governance can be reduced. There are three ways to reduce corruption. First, introduction of new institutions and laws. Second, target vulnerable service. Third, change service at grassroots. So now I am going to continue with 5.4.5. Ascertain the risk and reports on poor corporate governance. The objective of analysis study is to examine the relationship between corporate governance characteristics and risk disclosure practice. The corporate governance characteristics examined include board independence, the board size, board gender, auditor independence, and auditor tenure. To determine the level of risk disclosure, the study will employ content analysis, descriptive statistic, and multiple regressions will be used in the study to examine this relationship. Enrollment and welcome are some of the perfect examples of corporate governance failure in the past, and these scandals have raised concern on the reliability of companies' annual report as the primary source of information. It allows the company to realize the importance to have sound governance and at the same encourage the company for higher disclosure to the market. In Malaysia, Transmile case back in 2006 is the perfect example of corporate governance failure, where it was reported that the total revenue of the company in the last 3 years was purposely fabricated by Abdullah Zaimi 2007, Norwani Muhammad, and Czech 2011. Transmile scandal arguably was due to poor monitoring from the board and the failure of governance to ensure the reliability of information disclosure.
Now, I would like to present 5.5, that is, provide the discussion on the best practice in effective corporate governance. First, executive and non-executive director. Non-executive director. Non-executive director responsible for holding the entire board to account. Second, they help with the company performance and strategy and ensure that the board is operating effectively and acting in the best interest of the company and stakeholder, including shareholder. Besides that, non-executive director also brings special knowledge, skills and expertise to the board. Other than that, they also provide an independent view on the running of our business, governance and boardroom best practice. And the last one, oversee and continuously challenge management in its implementation of strategy within the group system of governance and the risk appetite set by the board. Now, for the executive director. The executive director, that is the senior operating officer or manager of an organization or corporation, usually at a non-profit, that is also responsible for strategy planning, working with the board of directors and operating within a budget. And besides that, they are also usually required by the board of directors. Executive director also work for the company in a senior capacity, usually concerns with policy matters or functional business area of major strategy importance. And the last one, member of the boards and at the same time full-time employees of the company. The second one, that is remuneration committee. Remuneration committees provide clarification to shareholders during general meetings on matters pertaining to remuneration of director and senior management, as well as the overall remuneration frameworks of the company. Remuneration committee means a committee of directors of the company having responsibility for considering matters related to the remuneration of director. The main role of the remuneration committee is to set the company remuneration policy, determine each executive director total individual remuneration package, and set the target for performance-related pay. As the code requires that no director should be involved in discussions about their own remuneration, the remuneration committee should be made up of independent non-executive director with a minimum membership of 3, or in the case of smaller companies, the majority of the members being independent non-executive director. The chairman of the committee should be independent non-executive director.
Next, I will continue the presentation with another best practice in effective corporate governance, which is audit committees. Audit committees oversee the system of internal controls and ensure that the company is compliant with laws and regulations. Audit committee oversight extend to IT security and also operational matters. Before the audit committee begins its work, committee member will need to understand how management develops and reports internal financial information. Audit committee should have at least one individual on the committee who is considered a financial expert. It's not necessary for all members of the committee to be financial experts, but they should be individuals who are knowledgeable about financial issues and who have a solid understanding of accounting principles and audit and finance terms and definitions. Having a good understanding of audit reports ensure that audit committee members will know the potential impact of financial statement. All audit committee members must also be up to speed on recent professional and regulatory changes and announcements. Audit committees are uniquely different from other committees in that they have more authority than most other types of committees. Audit committees review the results of the audit with senior managers and external auditors, including matters that managers generally share with the audit committee under general auditing standards. One of the primary responsibilities of the audit committee is to review significant accounting and reporting issues. Some of the board's most crucial duties are performed by the role of the audit committees. It's vital for the audit process to remain confidential until financial reports are thoroughly reviewed and ready for public release. The overall tasks of audit committees are to monitor and report on the statutory audit and financial reporting processes, including compliance with legislation, standards, and regulations. Next is to monitor internal controls and risk management system. Next, to monitor auditor independence and reporting and to facilitate the auditor selection process. Audit committee are also responsible to choose and oversee the issuer's independent accountant. The laws say that all committee members must be independent to preserve the integrity of the auditing process. Moving on to the next best practice is Audit Oversight Board. The Audit Oversight Board, AOB, is established under Part 3A of the Securities Commission Act Malaysia 1993, SCMA, which came into force on 1 April 2010. It is to promote and develop an effective audit oversight framework and to promote confidence in the quality and reliability of audited financial statements in Malaysia. Section 331E, subsection 1, subsection D of the Securities Commission Act 1993 SCA provides that one of the key responsibilities of the AOB is to conduct inspections and monitoring programs on auditors to assess the degree of compliance with auditing and ethical standards. In determining the type of sanction that is imposed on any contravention or breach, AOB takes into account the nature and seriousness of the offences, previous regulatory record, and other aggravating and mitigating factors. The example of sanctions are directing the person in breach to comply with the provisions of Part 3A of the SCA or any condition, written notice, or guidelines. Number 2 is reprimand. Number 3 is requiring professional education to be undertaken. Number 4 is assigning a reviewer to oversee an audit that is undertaken by the auditor concerned. And number 5, financial penalty of not exceeding Ringgit Malaysia of 500,000. Number 6 is prohibit the person concerned from accepting any public interest entity or scheduled fund as its client or preparing reports in relation to financial information of any public interest entity or scheduled fund as may be required under the securities law or guidelines issued by the Commission for a period not exceeding 12 months, and also number 7, prohibit the person concerned from auditing financial statements or preparing reports in relation to financial information of a public interest entity or scheduled fund as may be required under the securities law or guidelines issued by the Commission for a period not exceeding 12 months or permanently. The focus of Audit Oversight Board AOB enforcement is whether the auditors comply with the recognized auditing and ethical standards. Such action from the AOB may not necessarily imply the audited financial statement does not give a true and fair view. That's all from me. Thank you.
Thank you, Shokina, for your great explanation. Next, I'm Iza. I will continue with provide the explanation on reporting of corporate governance and corporate social responsibility. The reporting requirements for social responsibility, the first one is business overview. That is summarize the company's operations and its recent performance. Next, transparency, which is an opportunity to build trust between a company and its stakeholders. Then, authenticity, that is acknowledge the influence letter from the CEO. That is summarize the company's unique history and citizenship. Next, sustainable goals. It's identify and communicate goals relating environmental standards. Then, target performance summary. It's describe progress and any changes being made towards goal. Then, case study. It's provide in-depth research on a specific issue. Then, issue prioritization. It's identify and address the specific ways companies plan to improve CSR, then sources. It's enhanced credibility by citing internal or third-party sources. Next, I will move on with reporting requirements for corporate governance report. Firstly, a brief statement on listed entity philosophy on code of corporate governance. It is the company is formed only for lawful purpose and deals in an ethical manner. Then adequate opportunity is given to the shareholders. The audit committee acts independently. Next, board of directors. It shall contain composition and category of directors. Then transparency. It is an opportunity to build trust between a company and its stakeholders. Furthermore, audit committee nomination and remuneration committee. It is a brief description of the terms of the reference. Then every composition, names of members and chairperson should be mentioned. Next, meetings to be attended by the audit committee and the presence of them. Next, remuneration of directors. That is, non-executive directors should disclose all the pecuniary interests. Then, criteria for making payments to non-executive directors alternatively. Next, all the disclosures with respect to remuneration along with the further disclosure to be made as per Companies Act 2013. Moreover, Stakeholders Grievance Committee, it is all the name of non-executive directors heading the committee, name of the compliance officer and designation, complaints received by the shareholders, the number of pending complaints. Next, general body meetings. That is, place and times of the last 3 annual general meetings held. Whether any special resolutions are proposed to be conducted through postal ballot. To mention the names of persons who conduct the postal ballot exercise. And mention the procedure for postal ballot. Then, means of communication. That is quarterly results, newspaper wherein results normally published, any website where it is to be displayed. Then, presentation made to institutional investor or to analysis. Lastly, I will move on to strategies for social responsibility. There are 4 elements of corporate social responsibility. Firstly, workplace. That is mental health support. Suitable working conditions for those processes with disabilities. Diversity and inclusion. Supportive environment and policies for parents. Next, social issues. Charity Day policies, fundraising events, supporting charities, raising awareness about social issues that are important to employees. Next, environment, green initiatives, recycling facilities, sustainability policies, giving back to the local environment. Then, community, supporting local area initiatives, collecting internal clubs and societies, supportive social networks, easy to use internal comms process. Next, this is where we got our reference, that is from book and online. That's all from us. Thank you for your listening.